Imagine waking up tomorrow. The news is everywhere. Markets are crashing. Banks are in trouble. Companies are laying off workers. Social media is filled with panic. People are selling everything. Your retirement account is falling. Your investments are bleeding money. And suddenly, one question becomes more important than any other. Where should your money be during a crisis? In gold or in stocks? Millions of Americans have debated this question for decades. And every time a crisis hits, the argument starts again. Gold supporters say gold has protected wealth for thousands of years. Stock investors say the stock market always recovers. Both sides sound convincing. But only one side is telling the complete story. Today, we're going to examine the biggest financial crises of modern history. The Great Depression, the 1970s inflation crisis, the dot-com crash, the 2008 financial crisis, the COVID market crash. And you'll discover what actually happened to gold and stocks during each one. Not opinions, not predictions, real results. Because most people make investment decisions based on fear. Smart investors make decisions based on evidence. And by the end of this video, you'll understand why some investors become wealthy during crises while others lose years of progress. Let's begin with a simple truth. Most people misunderstand what gold is. Gold is not a business. Gold doesn't produce products. Gold doesn't generate profits. Gold doesn't hire workers. Gold doesn't create cash flow. Gold simply sits there. The same ounce of gold today does exactly what it did 100 years ago. Nothing. So why does it have value? Because humans trust it. For thousands of years, people have believed gold will hold value when other things fail. That trust is powerful. Very powerful. But stocks are completely different. When you buy stocks, you're buying ownership in real businesses. Businesses that make products, generate revenue, create profits, and over time, grow, so right away we see a major difference. Gold preserves wealth. Stocks create wealth. Remember that distinction, because it explains almost everything that happens during crises. Now let's look at history. Because history doesn't care about opinions. History only cares about results. And the results might surprise you. Let's travel back to 2008. The world was about to learn a lesson investors never forgot. The worst financial crisis since the Great Depression. Banks collapsed. Millions lost homes. Retirement accounts were devastated. Investors panicked. Many believed the financial system itself might fail. During this period, stocks suffered enormously. People watched years of gains disappear. Fear was everywhere. And gold? Gold became one of the most sought-after assets in the world. Investors rushed toward safety. Gold prices surged as confidence in financial institutions collapsed. At first glance, it looked like gold had won. But here's the part most people never hear. What happened next? The crisis ended. The economy recovered. Businesses adapted. Innovation continued, and stocks began one of the greatest bull markets in history. Over the following decade, stock investors experienced extraordinary growth. Gold investors, much slower growth. This pattern appears again and again. During the crisis itself, gold often shines. After the crisis, stocks usually dominate. Now let's examine another famous example, the 1970s. Inflation exploded. Prices soared. The dollar lost purchasing power. People feared for their financial future. Gold performed incredibly well during this period. Why? Because gold has historically been viewed as protection against inflation. When paper money loses value, investors often seek hard assets. Gold became a refuge. Stocks struggled. Gold appeared unstoppable. But then inflation was brought under control. Economic growth returned. And once again, businesses began creating wealth. Stocks eventually regained leadership. Notice the pattern. Gold performs best when fear is high. Stocks perform best when confidence returns. This is one of the most important investing lessons you'll ever learn. Fear can drive markets temporarily. Productivity drives markets permanently. Let's make this practical. Imagine two investors. Investor A puts $100,000 entirely into gold. Investor B puts $100,000 entirely into diversified stocks. A major crisis hits. Stocks fall. Investor A feels brilliant. Investor B feels terrible. But then 5, 10, or 15 years pass. The crisis fades. Businesses innovate. Technology advances. Profits grow. Historically, the stock investor often ends up significantly ahead. Why? Because businesses create value. Gold stores value. There's a huge difference. One grows the economic pie, the other protects a slice of the pie. This doesn't mean gold is bad. Far from it. Gold serves a purpose. The real question is understanding that purpose. And that's where most investors get confused. Here's what wealthy investors understand. The goal isn't choosing gold or stocks. The goal is understanding when each one matters. Think about insurance. You don't buy insurance because you expect disaster. You buy it because disaster is possible. Gold often functions similarly. It's not designed to make you rich. It's designed to help protect purchasing power during uncertainty. Stocks are different. Stocks are growth engines. They represent human innovation, human productivity, human progress. Every smartphone, every breakthrough medicine, every software platform, every technological advancement, all of it comes from businesses. And businesses are what stocks represent. This is why many of history's greatest investors favored productive assets. That's why the most successful investors rarely choose one extreme. They don't put everything into gold. They don't ignore risk completely. Instead, they build balanced portfolios. Some assets for protection, some assets for growth, some assets for opportunity. Because nobody knows exactly when the next crisis will arrive. The question is whether you'll be prepared. And that's the real lesson from this entire video. Gold can help protect wealth. Stocks can help build wealth. One helps you survive uncertainty. The other helps you benefit from progress. The smartest investors understand both, because financial success isn't about predicting the future. It's about being ready for whatever future arrives. So the next time someone asks gold or stocks, you'll know the better question. Not which one wins, but which one serves the purpose you need most. Protection or growth. Because understanding that difference could change your financial future forever. Before you leave, I want to hear from you. Imagine a major financial crisis starts. The stock market drops 40%. Fear spreads everywhere. You can only choose one investment to hold for the next 5 years. Would you choose gold or stocks? Type gold if you believe protecting wealth is more important during uncertain times. Type stocks if you believe long-term growth eventually wins. And most importantly, tell us why you made that choice. I'm genuinely curious to see what this community thinks. If you enjoyed this video and learned something new, don't forget to like, subscribe, and turn on notifications. Thanks for watching, and I'll see you in the next video.